Amidst the escalating trade confrontation between Beijing and Washington, China has taken a strategic step by appointing a new international trade representative. This move is seen as a harbinger of Beijing's readiness for a prolonged period of strained trade relations. As tariff battles between the world's two largest economies continue to destabilize global markets, the energy sector is feeling the full weight of these fluctuations. On one hand, the Trump administration is steadfastly implementing a tough tariff policy. On the other hand, Beijing is striving for balance in its relationship with the United States, even if it means mutual damage. The recent announcement by the United States of 245% tariffs on Chinese imports is a prime example of escalating tensions, where a product that cost $1 in the United States will now cost $3.45 in China. Against the backdrop of the unfolding trade and economic confrontation between the world's two largest powers, energy markets are becoming an arena for large-scale change. China, with its significant influence in global trade, is taking steps that indicate a revision of its energy priorities. There are reports of reduced purchases of American oil and liquefied natural gas, LNG, which opens up new opportunities for suppliers from Canada and other countries. To understand the reasons and possible consequences of these changes, it is necessary to carefully examine the context and key factors that determine China's energy policy. Trade tensions between China and the United States have been gradually increasing since 2022. Initially, mutual restrictions mainly affected the electronics, high-tech, and agricultural sectors. However, over time, the conflict has encompassed the automotive industry, mechanical engineering, the chemical industry, and finally, the energy sector. The U.S. administration, led by Donald Trump, has taken a course towards protectionism, proclaiming the slogan "America First." As part of this strategy, large-scale tariffs were imposed on Chinese goods, which provoked retaliatory measures from Beijing. From now on, America will be the sole priority. One of the most important aspects affected by the escalating confrontation is the trade in crude oil and liquefied natural gas. China is demonstrating a firm intention to respond to pressure from Washington with its own methods, introducing tariffs or formal restrictions on energy imports from the United States. Some time ago, the rapid growth in production caused by the American shale revolution seemed a very attractive opportunity for Beijing. Affordable American crude oil and LNG helped China cope with its colossal energy deficit, especially in the period 2017 to 2018. Energy trade between the two countries was gaining momentum, with China importing millions of barrels of crude oil from the United States and negotiating major LNG deals. There was even discussion of Chinese companies investing in American LNG production facilities as part of a number of promising projects. However, the escalation of the trade war has drastically changed the situation. Fresh data indicates that China has reduced its oil purchases from the United States by a substantial 90%, turning its attention towards Canada. Chinese imports of Canadian crude oil have reached unprecedented heights, as evidenced by recent Bloomberg data. The appetite of Chinese refiners and state-owned energy giants for Canadian heavy oil from the Western Canadian Sedimentary Basin is explained by its attractive price and reliable supply. Amid geopolitical turbulence, Canada is increasingly seen as a more predictable partner than the United States. In the medium term, the Canadian energy sector has the potential to significantly increase exports to China. Canadian producers, seeking to increase production of their technologically complex heavy oil, see the growing Asian demand as an opportunity for expansion. According to reports, Chinese importers have almost doubled their purchases of Canadian oil in the last 3 months. These trends confirm the hypothesis that Canada is successfully occupying the market niche previously occupied by the United States. Of course, the escalation of the trade war between China and the United States is an important factor explaining the reorientation of Chinese imports towards Canadian resources. In response to Washington's increase in tariffs on Chinese goods, Beijing has taken mirror measures, imposing high tariffs on American oil and liquefied natural gas. In some cases, these tariffs reach an impressive 25 to 30%, and according to some reports, even higher rates have been set for certain grades of oil. According to some reports, Chinese state-owned companies have received tacit instructions to refrain from transactions that benefit an unfriendly country. This development puts American exporters in an extremely difficult position. American oil, already facing logistical difficulties and diplomatic challenges, is now experiencing serious problems and price competition with major players such as Russia, Saudi Arabia, and Canada. However, the situation is not limited to oil alone. LNG purchases from the U.S. have also come under fire, with Beijing deciding to suspend imports. According to the latest data, LNG shipments from the U.S. to China have virtually ceased. In recent years, China has actively used American LNG to cover peak demand during cold winter months and meet the growing needs of its industries. However, tariff barriers and other restrictions erected in the path of U.S.-China trade are making adjustments. According to the New York Times, some American LNG suppliers are forced to reroute their cargoes around China or abandon existing contracts altogether. This turn of events strikes a blow to ambitious plans to increase U.S. export capacity in the field of liquefied natural gas. China, in turn, is looking for alternative sources of supply, turning its eyes to Russia, Qatar, and even trying to establish relations with Australia. Energy corporations are closely monitoring developments. Because the balance of power between importers and exporters in the U.S., the share of Canadian oil in the market, the growing volume of Russian supplies to China, and the actions of OPEC Plus are all links in the same chain, influencing price conditions in the oil and gas markets. In the event of rising prices, both China and the United States will lose. Lower prices, on the other hand, could hit the Russian economy, but American shale companies would also be on the verge of bankruptcy. In the intricate game of the global economy, a multifaceted conflict is unfolding, where triumph and defeat are intertwined in a complex dance. Trade battles, like an unabating storm, are multiplying their fronts, plunging the world into an abyss of uncertainty. In this battle, where energy resources become decisive cards, every move echoes in global markets, causing a wave of anxiety and speculation. According to analysts, China's decision to restrict exports of certain goods to the U.S. is a strategic response to trade pressure from Washington. The Trump administration, seeking to subdue Beijing to its will with economic levers, is facing unexpected resistance. China, like an experienced strategist, is demonstrating its willingness to strike at one of the key assets of the U.S., energy exports. In an era when the United States is confidently moving towards energy dominance, the loss of such a large consumer as China is a serious blow to Washington's ambitions. According to the U.S. Energy Information Administration (EIA), U.S. crude oil exports in 2022 reached an impressive 3 million barrels per day, and a significant portion of this volume was destined for China. Now that this supply channel is threatened, the U.S. is facing the need to rethink its energy strategy and seek new markets. A new reduction in oil production, reaching 90%, will result in the loss of hundreds of thousands of barrels per day. And although this may seem like a drop in the bucket in the global crude oil market, for American exporters, it is a direct blow to profitability and established sales channels. At the same time, China, which maintains close ties with Russia, is benefiting from Russian oil supplies at significantly reduced prices, which became possible after the Ukrainian crisis and the subsequent Western sanctions. In a situation where Moscow is actively looking for new markets, China is confidently taking a position as a key player, filling the resulting vacuum. Chinese refineries are willingly purchasing Russian Urals and ESBO crude oil grades at a discount of $10 to $15 per barrel. Coupled with imports from Canada, this leaves American suppliers with less and less room to maneuver. In fact, China is implementing a strategy of diversifying supply chains, strengthening cooperation with both Russia and Canada. This approach allows it to minimize dependence on the U.S. and strengthen its position in the face of the ongoing trade war. American oil companies, in turn, are trying to compensate for the loss of the Chinese market by reorienting exports to Europe and Latin America, but they face fierce competition in these areas as well. While Middle Eastern exporters, Russia, African states, and Canada are confidently expanding their presence in global markets, American producers have to face tough competition, look for new opportunities, and fight price pressure and high transportation costs. Oil companies, especially in Texas and Louisiana, are feeling the serious consequences of losing the Chinese market, which is the result of the Trump administration's trade policy. Despite industry concerns, Trump remains adamant, accusing China of exploiting America. While this approach may seem like a tactical political move, the question arises as to the long-term damage it could inflict on the energy sector. Trading oil with Canada also presents logistical challenges for China, as port and pipeline capacity on the Canadian west coast is currently limited. In addition, Canadian oil requires adaptation to Chinese refineries. Nevertheless, Beijing is actively negotiating with Canadian companies for medium-term supply guarantees, seeking to accelerate the implementation of infrastructure projects that will facilitate oil exports to Asia. Canada is actively developing infrastructure for energy exports to the Asia-Pacific region, including the construction of new terminals, expansion of tank farms, and pipeline networks on the Pacific coast. Despite the traditional difficulties associated with oil production in Western Canada, such as the development of oil sands and high production costs, the country has a chance to make a qualitative leap. The key to this could be the conclusion of long-term contracts with a major consumer like China. The deepening of energy cooperation between China and Canada indicates a gradual overcoming of the diplomatic disagreements that have clouded relations between the two countries in the past. Previously, tensions arose from restrictions imposed by Canada on the activities of Chinese technology companies, particularly Huawei, which provoked a response from Beijing. However, the increased confrontation with the United States in the international arena seems to have pushed China towards a more pragmatic approach in its relations with Canada. China is sending similar signals of readiness to expand cooperation to a number of European countries, seeing this as an opportunity to diversify economic ties in the face of increasing pressure from the United States. Some analysts believe that China is seeking to strengthen its position in the international arena by forming a coalition of countries interested in countering the influence of the United States. In the area of liquefied natural gas, LNG, it is important to note that the United States of America, thanks to the shale gas revolution, has been able to double its exports of this resource in just 5 years. Particular attention was paid to meeting the needs of the Asian market. One of the largest importers of LNG is the People's Republic of China. In 2021, China overtook Japan to become the world's largest importer of liquefied natural gas. However, in the context of increasing trade tensions, the tariffs imposed by China on LNG from the United States, and in some cases the policy of completely refusing to purchase from certain states, have put American LNG producers in an extremely difficult position. While they were actively seeking markets for increasing production volumes, they suddenly lost their largest customer. In this situation, American companies tried to conclude agreements with European buyers, but Europe is not ready to accept all offers due to political considerations and fierce price competition. Recently, European countries have turned their attention to LNG in connection with the crisis around Ukraine, but the cost of American LNG on the European market may be quite high. As a result, there are fluctuations in LNG export supplies, which undermines expectations of a stable and growing market. Canada is certainly bound by allied ties to the United States, but new vectors are forming in the sphere of trade that are different from the past. Canadian businesses, facing the prospect of cooperation with China, are wondering whether this will cause dissatisfaction in Washington. Ultimately, each company's priority is its own benefit. The Canadian government takes a position of non-interference, emphasizing that these are commercial transactions between private oil companies and Chinese consumers. All this indicates a multifaceted struggle for influence between the U.S. and China. Confrontation and retaliatory steps are observed everywhere, in the technology industry, agriculture, the financial sector, and energy. Trade in energy resources is becoming a powerful tool in the hands of both sides. China is responding to American protectionist measures by reducing purchases of oil and gas. As a result, American oil exports to China have plummeted, liquefied natural gas supplies have virtually ceased, and Beijing has stepped up cooperation with Canada and Russia. Such changes are capable of changing the global map of oil and gas flows in the long term. Geopolitical winds of change clearly indicate the possibility of a shift in the energy corridor from the United States to Canada. Such a turn of events could significantly strengthen the position of the northern neighbor both in the diplomatic arena and in economic terms. However, the future horizon is still shrouded in a fog of uncertainty, and the exact consequences of this potential transformation remain unclear. One possible scenario suggests that Washington and Beijing will eventually find common ground and sit down at the negotiating table. In this case, the escalation of the trade war will subside, and energy flows will gradually return to normal. At the same time, there is an alternative scenario in which tensions between the two largest economies in the world become chronic. Then, Beijing will continue its course towards an almost complete rejection of American oil and liquefied natural gas, and exporters from the United States will have to look for new markets. In this situation, China may conclude a number of major agreements with Canada, purchase Russian oil at a significant discount and strengthen ties with other OPEC+ countries. In such a development, the United States risks losing market share in the Far East region and may be forced to pursue a more aggressive sales policy in Europe and Latin America. However, it is worth admitting that the loss of such a colossal consumer as China will be extremely difficult to compensate for. American energy companies, especially during the recovery of the global economy after the pandemic, are closely monitoring the growth in energy demand and the prospects for meeting it. The People's Republic of China continues to play a key role in world trade, remaining one of the largest importers and satisfying a significant share of global demand. However, a logical question arises: what will this complex and painful process of confrontation lead to? At the moment, there is no clear end to this struggle. It is likely that both economic giants will continue to adhere to their occupied positions. The United States of America does not show any intention to abolish the imposed tariffs, which expire only in 2025. In response, China declares its readiness to continue responding with mirror measures. According to analysts, this shift in the energy sector could last until 2026 to 2027. Years of trade war can further fragment the global economy and wreak havoc on global supply chains. Ultimately, each side will suffer losses as a result of this confrontation, but political considerations may overshadow economic losses. Some experts suggest that the United States of America may take the initiative during the re-election period and try to change the situation, but the political situation remains extremely unstable. In the U.S., voices calling for an end to trade with China are growing louder, while in China, support for the idea of reducing dependence on the American market is growing. Behind the scenes of loud populist statements, the art of diplomacy is fading, and the usual routes of world trade are undergoing radical changes. Just look at the energy sector. China seems to have demonstratively slammed the door on American oil suppliers, reorienting itself to Canada. This episode is just one of many that testify to the profound shifts in global energy markets, but it is also striking. Statistics confirm that Chinese oil imports from the United States have collapsed by 90%, and purchases of American liquefied natural gas have almost ceased. At the same time, China, as if responding to Washington's actions, is increasing purchases of Canadian oil to record levels, forming alternative supply channels linking Russia and Canada bypassing the United States. American companies, having lost such a large market, are trying to compensate for losses at the expense of other regions, but exporters and investors are increasingly concerned about the general atmosphere of the trade war. This new equilibrium clearly demonstrates the price that the energy sector has to pay for the escalation of the trade confrontation. It is too early to judge who will ultimately be the winner and who will be the loser. One thing is clear: the growing tension between Washington and Beijing is capable of fundamentally reshaping the global energy map, creating new alliances and redistributing resource flows. In the modern world, commerce is increasingly becoming a field of political battles, and the energy industry is no exception.